Hi, this is Keith Schneider, and this is the November 15th edition of Market Outlook. First and foremost, I'd like to extend my condolences to all those affected by the terrorist attacks this week in France. Now, moving on to the markets, let's take a look at the S&P. Last week, we noted that we were in a very critical area and certainly holding above the 206 level, which was above the 200-day moving average. We had moved into an accumulation phase, but we really had to hold above it. This week, with the drop below the critical level that I mentioned, it certainly basically gapped down to that level on Thursday, really had a meager rally, never looked back, and basically you got a pretty serious sell-off from there as well. So markets under pressure. Couple things to note in the S&P. Number one, we're basically at pretty oversold levels on a purely price momentum basis. Let's take a look at a couple of other market sentiment indicators as well and market internals. First of all, the indicators. You can see that what happened here is that with this sell-off, all of our indicators, the McClellan oscillator, which looks out over several weeks, is now at oversold levels below the lower green line. Does that mean it can't go lower? Certainly, right? In August we were. But this is where rallies start to mature from, or start from. Okay? We are also in a situation where our shorter term indicators, up-down volume, also touching oversold levels. Does it have a lot more to go potentially? Absolutely. But considering that the up-down volume, the advanced decline on the shorter term time frame, so that looks out over a couple of days to maybe a week or more, is also oversold. So that, in conjunction with the McClellan, these things are all oversold. When you get that coincidence, that produces your strongest buy signals. So we should be on the lookout for a potential bottoming pattern here, and maybe a hold of that 50-day moving average. Let's go back to this chart here on the S&P. And as you can see, we've got the S&P down around that 200 level. After that, it's pretty dicey. We want to see at least the gap being held at about the 196, 197 level. This was an unfilled gap. I would prefer to see that unfilled. So two levels of support, 200.82 or 201 level, as well as about, let's get this a little bit more precise, around 196.50 would also should materialize as good support if it indeed has the inclination to hold those lows, which would be a positive sign. Another thing to note here, on Friday, good volume, greater than the 50-day average, so that is certainly a real distribution day. So definite more evidence for a continued sell-off as well. So things can get a little bit more deeply oversold. Let's take a look at sentiment. Really interesting chart here. This is looking at, as you can see, 3-month versus 1-month volatility. It's not a lagging indicator, but a leading one. And what we have here is this green line is a moving average of the ratio. When that ratio moves above 1.2 and turns down, that is a sell signal. So you can see right now, 1.0 is where buy signals start to happen from. At this point, the ratio has definitely some more room to the downside, and it's rolling over. So if we can get sentiment along with the market internals to get oversold around the same time, which looks like we have, we potentially have got a setup going into year end that could be really positive. Let's take a look at a couple of other things. Transportation. We spoke about the problem with transportation. IYT, this is also not a good indicator. What happened here? IYT actually which is the Transportation Index, ETF, you can see we really couldn't get going much above the 200-day moving average. Quite a bit different than the key indices, the S&P and everything across the board. So with that, of course, with Dow theory, without getting a confirmation in the transportation, we're definitely more suspect, and that's what we called out last week. Had we improved in condition or phase? Absolutely. However, things were not the same as they were several months ago and on some of the other declines throughout 2015 and even the late part of 2014. Big difference. So in this case, right now, 50-day moving average under the 200, and we closed under the 200. So we're definitely looking at a potential test of the lows here on a sell-off. On the other hand, watching this IYT, if we can get a close or at least two closes back above that 50-day moving average, it would give me a little bit more confidence about the markets as well. So that pretty much wraps up the S&P market internals. One last thing I'd like to point out, calendar ranges as well. Interesting. As you can see on the calendar range, this deep green line here is the 6-month calendar range high that was set back in July. We attempted to get through it. It failed. The 1-month calendar range set only on the first day of November. We traded underneath it, this blue line here, and that also put sort of the nail in the coffin here as we closed under that on a Wednesday and followed through deeply on Friday, and also broke the 6-month calendar range low. So definitely under pressure. Would like to see that S&P chart hold around certainly that 50-day moving average, and or at least where that gap occurred, that breakaway gap that occurred off the lows, which was right here in early October. Would really like to see that hold. That is your next logical level of support if we cut through that 200.8 level, or about right there. All right, so that pretty much wraps up this week's video. You can see markets are definitely very dicey with that tragic event in Paris. Obviously, the global market psyche could have been damaged. So it'll be interesting to see what the central bankers do to stem that as well. So it could put a hold with this sell-off, could put a hold on any rate rise by the Fed, but that remains to be seen. And again, even on Friday with that massive sell-off in the markets, bonds moved up, but nearly not as much percentage-wise as the underlying indices. So it's pretty dicey to make the call here. It's more of a coin toss. It's hard to know, but clearly the calendar range setup in bonds is definitely on the bearish side, meaning the market indication here from looking at the charts, unless we can get above that 6-month green line calendar range around 121, that would give me a bit more confidence that the rate rise is not going to be happening in December. All right, stay frosty, and we will see you next week. Bye for now.